You're listening to Money Talks. My name is Michael Campbell. Money Talks is brought to you by Solera Club. Solera Club is a royalty investment. That means you get paid first. There's no fees attached with it. It is in the tech sector. For more information, go to soleraclub.com. Let me start with a summation of what this show is all about in 36 words. It's the age of consequences, the demise of the welfare state, declining confidence in government, and the impact that all of these trends have on your personal finances, including currencies, stocks, bonds, real estate, food prices, travel costs. That's about it. If you want to know what's going on, there are no trends more important to understand that have a bigger impact on your personal finances. But those are difficult themes for the vast majority of the public, the political establishment, organized labor, big business, the mainstream media to grasp. I mean, it's upsetting to think that the status quo is crumbling. No matter though, they're happening anyways. I smile with that sort of very small world view that thinks that the rise of Donald Trump is unique, the political outsider phenomena. Well, it's worldwide and happened well before Donald Trump. The governing party in Greece, Syriza, was formed less than 2 years after taking power. Italy's recently formed Antiestablishment five-star movement's about to take charge of Rome's government. A couple of weeks ago, we talked about Iceland's Pirate Party leading the polls, thereby qualifying for the highest amount of government funding. The big news hitting the markets on Friday was the latest poll out of the UK showing that the Brexit now leads the Euro crowd by 10%. That's just been a steady increase in support for leaving the EU. Across Europe, anti-establishment fringe parties are absolutely surging. My point is that Donald Trump, Bernie Saunders are nothing new. On this show, 2013, Martin Armstrong talked about the rise of the third-party political outsiders coming to the forefront by 2015 and beyond. Obviously, that was a good call. Trump and Bernie Saunders are just the latest U.S. manifestation of the same trend, dissatisfaction with elites. Hey, we witnessed the same phenomena in Vancouver just over a year ago with the transit referendum. All the big labor, business, political elites lined up in favor. They had the money to push their position, but what they didn't have was support. The elites lost badly, and it was clearly an anti-establishment vote. But I don't think they get it. Sadly, still arrogant, and worse, ignorant of the reasons behind the trend. And none of them understand Trump. More importantly, they don't understand that he's just the beginning of a trend. One of the key, if not the key question coming is, who or what comes next after Donald Trump, Bernie Saunders? That's one of the key political and economic questions in the next decade. And I'll tell you, the election of Hillary Clinton, the ultimate establishment elitist candidate, Wall Street's candidate, as Bernie Saunders says, is going to exacerbate this trend. It's going to get the U.S. much more involved in the trend. The backlash against the political elites has begun. More accurately, in the methodology I use, it's a reversal. It's taken place. And the trend is going to be propelled by a litany of broken promises by the welfare state, starting with unfunded public sector pensions, compounded by major debt problems. There's no getting away from it. When you talk about unfunded pensions, there's only three choices. Either retirees will see their benefits slashed, retirement age will be raised, or taxpayers will be forced to pay more tax just to top up public sector pensions when they can't afford to contribute to their own retirement. That spells trouble. It's already happening in Detroit, Chicago, Puerto Rico, Atlantic City, Stockton. Unfortunately for Canadians, very fortunately, our Canada pension plan is stable, but that's not the case in the States with Social Security. The math just doesn't add up there, and changes will be made, and they are going to be greeted with anger. But anger's nothing new. We've seen anger with the establishment already manifest with race-motivated violence in Ferguson, Missouri, Baltimore, Maryland, the Oakland riots in '09 over the killing of black youths. You know, there's 95 million permanently unemployed Americans, millions of them disenfranchised young people, impoverished older people, people who lost their jobs due to technological substitution. They don't even exist in the consciousness of the Washington elites. I don't see anyone in the mainstream media. I've even got a lot of friends in academia and the economic side who just don't get this trend. Nobody in politics or the educational establishment understand it, yet they all contribute to it by fostering unrealistic sets of expectations for government. Free lunch, unrealistic job creation promises, the trend away from individual responsibility in favor of the elitists in government. the inevitable disappointment follows. The disenchantment grows. My God, just look at Europe right now. People who think politics first just don't get this. And judging by some of my emails, they're furious I bring it up, challenging their political heroes. How dare I? It doesn't matter. Your political heroes aren't going to change demographics, compound interest on public debt. They aren't going to stop the deflation. None of it's happened. Sadly, in their search for control, they're going to actually make matters worse. The absurdity of raising taxes to improve economic growth in zero growth environments is absolutely absurd, and yet we're seeing it. I say, welcome to the age of consequences. Capital moves all around the world in search of safety, safe from corruption, cronyism, incompetence, financial mayhem. And presto, it's localized, the impact. Look at the mid to upper end of Vancouver's real estate market. Collectibles go through the roof. Look at some of the sales of art. Currencies decline. The U.S. dollar becomes a safe haven. Central banks push interest rates to record lows, killing savers and pensions. Trump and Hillary were predictable. They both confirm and exacerbate the trend of disenchantment with government. They will start, whichever wins, their term with the highest disapproval ratings in history. The divisions within the country will only exacerbate. The question, and this is the big one that we'll be dealing with every day, what happens when confidence in the U.S. government erodes? Where does capital move then? That's why this trend is absolutely key to every one of the financial issues I alluded to at the top. Donald Trump, are you kidding? That guy's just the opening act. Money Talks is brought to you by Solera Club. Solera Club is a technology-based investment, but it's royalty, so you get paid first. No fees. More information, go to soleraclub.com. Stay with us. Coming up, I got Mike's big, fat idea. Then I got my favorite tweet. I got this clip I got to play you from Obama that is just absolutely hilarious. All of that coming up shortly. Stay with me. I'm going to share with you my favorite story of the week. It's cool. It's just ultra cool. Also, Martin Mirenbield joining me. I've got lots of questions for Martin, so stay with us for that. But right now, very pleased to welcome back to Drew Zimmerman. Drew, it's time for the big fat idea, so let's start right into it.
Well, Mike, this week my big fat idea is ways to participate in the gold market. I think that's very fitting, given that your next guest is Martin Mirenbield.
Well, let's talk about that for a bit. I mean, what makes you like that idea? Like, you're talking about playing the gold market to go up.
Yes. I mean, you can play it to go up. That definitely seems to be the way that most investors are looking at it. I think investors are saying gold peaked at 1,900 5 years ago. We're really looking to the lows made at the end of last year as possibly being the lows of that 5-year bear market. So if we want to look at a market that's potentially going into a multi-year bull market, what are the best ways to participate?
Okay, well, let's talk about that, because that's an important side. I mean, obviously, we can buy stocks, we can buy bullion, we can buy ETFs, we can leverage the heck out of stuff. What are you suggesting for people?
Well, call me old-fashioned, Mike, but I think if you want to trade gold, you should be trading gold. And there's no simpler way than a futures contract. It is 100 ounces of gold, plain and simple. But people do go and trade gold miners or triple-levered gold ETFs because they want leverage to gold. Well, let me tell you, Mike, we can give you that. The futures market have leverage and then leverage. It's more my job to stop people from taking too much leverage in the gold futures market.
Well, it's a good point, because when people think of futures market, they do think of leveraging up, but you don't have to. Like if you have a 100-ounce, contract for gold, you can pay 100% cash for that. You can pay 50% and get a double leverage. You've got lots of choices within that context. And obviously, a professional like yourself would explain it to people, but you can just go straight out and do it. What about the option side? I mean, I've been on the show for years, Drew, begging people to at least understand their opportunities with options. I just think in this marketplace, I just saw Mark Leibovit, for example, saying to his subscribers that he thinks they should buy an option that protects them if the market overall goes down. That would be a great example. And obviously you can use options within the gold market too.
The option market on gold is tremendous. I think it's a great tool that, like you say, people need to try and understand and try to utilize. I'll give you an example. I priced this out on Friday just before the close. Gold was at $12.75. If you want to be getting long the gold market, you could sell a $12.60 put. You're taking in $25. So you're either taking in a $2,500 premium that you get to keep if the gold market stays the same or goes higher, or, and what I think is key, you start to build your long position at lower than market prices. You're getting into the market at $12.35. That's $40 under where the market was priced on Friday. That is the power of options.
Yeah, I love selling puts because I feel they are safer. So in this case, you're saying you give someone the right to sell you gold at $1,260. And for that right, it's like an insurance policy for him. He's the one who's got a lot of gold, and he says, hey, what if it goes down? I want to be protected. Hey, he gives you $25, for a certain period of time, and he can sell it to you at $12.60, but you've taken $25. That means presto, you just bought gold at $12.35. If it stays above $12.60, he's already going to sell it to you. He'll sell it in the market. You still keep the $25. Yeah, I've loved that kind of stuff for starting positions, just as you're describing, whether we're talking about some quality stocks or, as you just alluded to, in the gold thing. What do you think this is the risks for, though? I mean, do you consider, let's just go with the selling put approach. How do you classify the risk of that?
Like you say, it's an approach for somebody who wants to initiate a position. So rather than stepping into the market on any given day that I think is the right time at the right price, I'm going to look to build a position at lower prices. So you can look at it in a sense and say, I'm taking some of the risk out because I'm getting into a market at much lower prices than they are today, where I think I should get in. At the same time, you are building a position in gold, so it would hold the same sort of risk that if you stepped into a gold position today. So you do have to be wary of that even though
you've got to be prepared to buy the gold, but it's at a 25 exactly. Or as you said, a $40 discount because the gold's selling at $12.75. You're giving someone the right to sell it to you at $12.60, and you took in $25. That's $2,500 in your pocket no matter what happens. So, I've always felt that was sort of if you liked gold and, you're taking less risk inherent than just buying gold, because you're getting the discount if you happen to buy. The bad news, though, Drew, this has happened to me, or the other side of it. It's not bad news because I take $25 and no matter what. If gold makes its big move like to $13.80 or something, you only get the $25. That's it.
That is very true, and that's where I look at this strategy as part of a complete strategy. Whether you're buying one futures and selling one put, and you're lowering your overall price, there's obviously a multitude of strategies that you can look at.
Sure,
this is just one of them to outline that really does show people that hey, you can get into the gold market $40 under where it is if you think that's a long-term buy.
Absolutely. Well, Drew, and that's why they talk to professionals like yourself. Drew Zimmerman is an investment advisor at PI Financial. Drew, thanks for taking the time.
Thanks for having me on this weekend, Mike.
Hey, wait till you hear this. Stay with me. I'm going to play you that Obama video from a speech he gave at Elkhart, Indiana last week. The other thing, I got a special tweet of the week for you, so stay with us here on the Money Talks Network. Coming up, I got my quote of the week. I got Martin Mierenbield. We've got a Goofy Award for you, so lots coming your way. This is something I think broadcasters at least can identify with. I'm a big stutterer. I'm an ummer. I do all of these things. Well, I'm not alone, though. I heard President Obama this past week, and I'm playing it because I thought it was pretty darn funny. He's speaking, the teleprompter goes. He's been sort of accused of saying, without that teleprompter, he's not such a good orator. I'm afraid he gave fuel to that fire. Let me just play it for you.